Right, come on in, come on in. We're sending out the invites. We're going to get the live studio audience in here, and then we're going to get it rolling. Oops. We don't want that. We wanted this. All right. Is this market correction turning into a crash? Are these earnings announcements not good enough? Is AI dead? Find out today on this show with a 30-year expert. Yeah, I'm not wearing a three-piece suit. I'm not in New York City. You know why? Because I'm retired. I've been retired for almost 17 years. Multi-millionaire, seven-figure a year earning stock analyst who was a consultant to guys like Jim Cramer. Stay tuned or just push forward to the disclaimers. We're going to let people come in here for 1 minute and we're going to get this show started like we do every week. If you're new, don't go anywhere. Give this thing a shot because I am not like the 10,000 clowns out there that pretend they really know how to analyze stocks out there. You're going to see. If you didn't see yesterday's show, that was pure demonstration of what real stock analysis is about. Not what they pretend to teach you in college, not what they pretend to teach you on CNBC. Neither one of them are teaching you what you need to know and make money in up and down markets like what we are having right now. So let's get to it. Let's see what our audience looks like at the moment. Boom. Audio check, video check, check, check. Check one, check two. Let's see what we got. Yeah, we're there. And you guys, the members of the hashtag team, doing your job, spreading the word. And as a result, we don't have any more delays. You know what we have? We have Friday. We got Money Mark, we got Stock Talk Live. And just like my New England Patriots, the investments that we make in the future pay off in the present, with the Patriots being the first team to get to with number one record in the NFL. I'm sorry, I don't mean to, press any buttons out there. It's just the way it is. We deal with professionalism, you get professional results. And that's what we're dealing with right here. We got the numbers, so we're going to get into the disclaimers. That's on the screen. I'm not going to read this for you, but suffice it to say, I'm not a registered financial advisor. I'm actually registered as a day trader with the IRS. As a result, I take advantage of market moves out there. I expect that none of you will take anything I say as a reason to move a stock. So if a stock moves, I reserve the right to do what I want with those stocks at any given time. Need to cover, CYA, right? And so suffice it to say that this is just a parody of CNBC and the financial press, and that this content is for informational, educational, and entertainment purposes only. All right, that's enough of that. We got more important things to do than put disclaimers and disclosures out there. And we also got more important things. Look, in the description of this video is everything. If you're new, it's up to you, okay, to understand the lingo coming from me. Because like I said in the intro, I am not like the 10,000 clowns out there that's going to talk about charts and P ratios and stuff like that. The charts I use are proprietary charts of risk reward, not technical analysis. And that is my secret, okay? You've got this here, you've got this here, all this in the description of the video. You want to read this article, you want to listen to this replay of Spaces, and you want to watch this video, Making Money with Mark, there we go, Making Millions with Mark, and none of this has any sponsorships, subscriptions, advertisements, no nothing. There's no tricks. And why? Why would somebody like me do this? Simple. Because I was living in a basement, not a basement apartment, spending $300 total a month. That's for rent, food, utilities, etc. And now I live in a penthouse in Miami Beach on Ocean Drive, earning 7 figures a year. How? Because my mentor took me out of that, turned me from a losing stock picker, which college created, okay? College gave me overconfidence. College gave me the tools to be a losing stock analyst. And my mentor taught me the real way. Okay, I've talked about this in the past, so I'm not gonna, knock on colleges anymore today. But just suffice it to say, that is my take on these things. My track record is out there. You know my real name, you got my real credentials, and you have my real track record in live in real time. No losing picks still since May of last year, and before this spreadsheet came into existence in 2014. Bro, this is 11 years of 46% year over year annualized returns. And even before this spreadsheet existed, I was on Seeking Alpha and picked 24 triples in 5 years. You'll find out all about that in my old videos, and also in the description of this video has links to everything you need to know. All right, enough of that. Let's get into it because we have so much to discuss today. And by the way, for those of you who have questions, put question mark at the beginning of your question. That'll make it easier for me to find. I will answer questions until 3:55 p.m. Okay, at which point we will sign off for the weekend. Let's get into it. What do we got here? The Fear Greed Index. We're going to start with, like we do every week, to see where we're at. We are at extreme greed, extreme fear levels, the likes of which we haven't seen since the taper tantrum, right? But the indicators out there dictate continued caution. We'll go to the charts immediately. Oops, there are the charts. IWM, all right, pretty close to the red line, but coming down hard off of those levels. We have been heavily hedged in the market. If you follow the yellow alert rules that I teach, my largest position being RWM. And if we zoom in on this decline that you're seeing in the market, right, RWM is going up, because that's what RWM does. It's a hedge against the market going down to protect your assets. Go watch the video, read the article, and listen to the spaces to understand more. You veterans already know what I'm talking about. There's the cues. Remember what I told you when we hit the yellow alert? The red line, this proprietary red line of mine, that the market was expensive, and now we've come back down to the red line. That doesn't mean we can't go higher. That doesn't mean that AI can't become a bubble, because we've certainly seen some bubbles form, but now we're seeing the Q's coming down. We're seeing the S&P coming back down towards the red line. We see Nvidia coming back down towards the red line. You see Oracle came all the way back. I mean, crashing hard. I told y'all to short the stock back here. Got out of that short on the low-hanging fruit, but it's down 37% from there. That's what happens when you have overvaluation. All right. And for those who don't remember, I've talked about this before. I have been covering Oracle going back to beyond where this chart is right now, about here. Okay, this is where I started covering Oracle for International Data Corporation. You can look it up. And then when I joined AMR Research, right about here, I covered them from there. And then when I left AMR Research and formed my own company, dealing with companies owned by Jim Cramer, George Soros, and if you saw the movie Dumb Money, you should, Stevie Cohen. For my own company here, I covered Oracle until I retired. I was known as one of the best guys out there in terms of calling Oracle's quarters. So you knew when I came out and told you that this shouldn't be, that this shouldn't be. All right, this isn't something that technical analysts will give you. This is not something that the other 10,000 people out there will give you. This is something you only get by having the expertise specific to these companies and what they do. You need to understand these companies as if you are the CEO. Now, you got better things to do. You got careers of your own. And that's why you tune into me, because that's what I did for my career. That's what I do now to continue managing my family's money, even though I don't sell my services to Wall Street anymore. And for 2 hours every week, I come and give this information to you. Everything I learn over the course of the week, culminating into a giant call that I have once a week with my fellow multi-decade Wall Street expert, retirees and semi-retirees, all millionaires. And then I take all that info and give it to you each week for 2 hours. That's just my way of giving back. All right, we are at the greed. I've given you all the little speeches that you need to hear about. So we're going to get into stocks right now. The 2-year has been ticking up recently. I don't believe that's going to continue. Personally, we had the government shutdown. when the government shuts down, just trust me on this. I'm not going to bore you with the details, but you ought to know. And when the government shuts down, liquidity gets sucked out of the market. And if you've been watching me, you know that liquidity is perhaps, in my estimation, the most underrated force in the market. Most of you, RSI, moving average, blah, 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 the news. No, liquidity. If you don't understand liquidity, then you don't know the most powerful force in the marketplace, okay? So stay tuned with that. But now that the government is back open, just know that liquidity can now start coming back into the market. And with the jobs figures that we've been seeing, with the inflation numbers that I expect us to see, I expect interest rates to tick lower, even though there is fear in the marketplace that the Fed is not going to come to the rescue. It always does. And if it doesn't right now, just wait until we have a new Fed early next year. All right, so we'll stick to that. So I am short-term optimistic that at some point before year end, the market can turn around on liquidity, but we remain on the flip side of the coin in a yellow alert. So the long-term valuation are too high. So you have to be in the right names. You have to have your hedges in place. You have to be mindful and have your head on a swivel. And by the way, lots of cash. My largest position is RWM. Well, not really. My largest position is BOXX, a money market ETF. That's basically cash earning about 4% a year. Why? Because when the markets crash, you want to have cash. If you don't have cash, then you can't take advantage of those market drops. All right, so that's the market. Let's get into stocks. Bro, we had, and keep saying bro, you ladies out there, I love y'all. All right, 1% of this audience is female, and don't feel left out. This is a bro show, but really it's for the ladies. We had 10, count them, 10 earnings announcements amongst names that I follow, cover, and have in my official portfolio, and we had blowouts as a whole. Y'all saw what happened to Curiosity Stream, right? Yesterday, big move, gap up, stock was up as much as 35% at one point. IDN, spike up as much as 53% yesterday. We're going to talk about them, and we're going to talk about TSSI, which, if you remember, I was the first person on the planet to prove that TSSI was doing business with XAI, with Dell, with Elon Musk, and that precipitated a move in the stock from 2 to 20, ultimately 30. I had nothing to do with that, right? And risk reward rules said to sell at 20. The stock dropped, got down to the lower end of the risk reward range. We'll zoom in here so you can see a little bit better. And by the way, if you haven't taken in my educational materials, you won't know the difference between what these white lines are and this red line is and what this green line is. The veterans know, so I'm not going to explain it. You already know. When this got close to the red line, it was a sell. When it got close to the green line, it was a buy. When it got back to the red line, it was a sell. And then, on top of it all, I dropped the bombshell here on Stock Talk Live, gave you the information you needed to know that this is a dangerous stock. I removed it from my portfolios, my official portfolio, my unofficial portfolio, my personal portfolio, everything. Got it out. And now where are we? Down 44% today. We're going to talk about the earnings announcement. We're going to look through my model, my personal model, and what that means for the future of TSSI so you can make your decision on what to do. You know what the rules say, but you can make your own decisions. We're all big boys and girls here. So stay tuned for that. But we're going to lead off with Koru Medical. I gave you guys this one over the summer. Told you that these guys were going to beat every number for the remainder of the year, that the guidance for the year was too low. And what did they do? They blew it out last night. All right. This was 2 nights ago. Sorry. On Wednesday night, 27% growth for a sleepy company. What happens when a sleepy company announces 27% growth? That's what happens. The stock spikes. We got a 17% spike in a company that is very safe, based on the business that they're in. Okay, we're zooming in here. Let me see. Give you a good look at what the chart looks like at this moment. There we are. Notice there's no red or green lines, but this is a good indication of my belief of value. In fact, these should be white, not gray, because you know white indicates, boom. White indicates where I think the red and green lines should go. Let's see, let's create a parallel line and put that there. Good enough for now. And there you go. All right, we're still within the technical channel, still rising within the technical channel, still not at the top of the technical channel. This stock remains very viable at this moment in time in the marketplace. I still own this stock. I'm very happy owning this stock because I think there's great upside in this name compared to the downside, and that's what it's all about, your risk and reward. A lot of people forget about risk. You want to buy a biotech that can be a 10-bagger, not thinking that the chances of that happening are only 1%, and there's a 99% chance that the stock goes down 50%. And if you don't understand the math behind weighted average probabilities, what I just described to you is called a bad bet. My job is to give you good bets. All right, this is a good bet right here. Continues to be a good bet based on what they did. We'll leave it at that. If you have any questions, you can put it in the queue because we got a lot to go through. I just want to let you know, boom, another winner out there for y'all. IDN. I mean, we're going in no particular order. I would rather save IDN for a little bit later because this was juicy. This was, look at that. Look at that move. And you see the risk reward chart. All right. So it's interesting because I know some of you will ask, Mark, why did you take it out of your official portfolio yesterday? Simple. Temporary move, my friends. I will, mark my words, I will own this stock again. But when you get a 50% move, 55% on earnings, the revenue grew 28%. The stock grew 55%. I saw the volume. I understood what was going on. That volume was not Wall Street volume. That was retail volume because somebody out there must have gotten excited, the day traders, about the fact that Facebook gave them mid-five figures of revenue in the quarter. Now, by the way, that's a whoop-de-doo, mid-five figures. All right, I make my mid-five figures a day. But they gave guidance to that doubling to low six figures next quarter. And I think that's what got people excited. Now, by the way, low six figures is also whoop-de-doo. Because ultimately, if Facebook really gets up and running, I've told you before that this can be a $3 to $5 million a year business. That's $1 million per quarter. Not five figures, not six figures, seven figures. But we're not there yet. Okay? So that's one thing. Number two, the retail business continues to have issues. That's 30% of their business. So as we go into Q4, where we are usually looking for seasonal strength out of the retail business, we're probably not going to see so much. That doesn't mean they're going to have a bad Q4. I think it's still going to be a good Q4. And then after that, it's lit. But in the meantime, I bounced out of the stock. Why? Because of that massive move. All right. And it has this pattern right here. This is a classic day trader pattern. Okay. So what I would expect is maybe a drift lower, maybe not, because the day traders love this thing. So they might keep it up. That's the bet that I'm making, is that we can get this a little bit lower. But I got out of the spreadsheet at 660 something per share, up in this range. We got out. So now if you were following the spreadsheet, it's my live spreadsheet, so it's there for you to monitor, right? There is the IntelliCheck. We'll turn this white because it's now out of the spreadsheet. For now, it is going to go back in. Trust me, from what I know about the business. I might be being too cute, but when you get a 57% gain, this was the stock that was threatening to break my streak. This was the one number that was negative in this spreadsheet from time to time. And then, boom, 57%. That's what happens when you pick good stocks, okay? Take some profits there. Now it's down 10% from those levels. Somewhere in the mid-fives, right? That's where I stopped being so cute about this. Because the fact of the matter is, if you look back, this stock was already around these levels a few months ago. Okay? So this is purely a trade move that I made based on the fact that I identified this day trading pattern that I've seen oh so many times and anticipated the stock would pull back. Now that it has pulled back 10%, do you want to bail out of this stock? I don't know. I don't know. If I had woken up today, missed the last few days, saw that the stock was at 591, I don't know if I ought to make the same move, okay? This company is in great shape. It's as good as I thought it was before. Nothing has changed about that, so keep that in mind. All I did was make that move so people take some profits at 661, but now we're down in the 590s. Each penny down gets me more excited about getting back in, which can happen at any moment, like the disclaimer said. So, hey, SEC, chill out. I'm here being upfront about everything I do here. So that's IntelliCheck. If you got any questions about that, put it in the queue. We got to keep moving here. Oh, by the way, here's the model. And here's the thing that I'm talking about with these guys. If they do what I think they can do next year, the year after, and the year after that, we're talking about basically going from 25 to 50 to 75 cents in multiple years. That means that this stock can do something like this over the next few years. All right? If Facebook comes through and becomes bigger, it's been a long time. We've been waiting for literally years for Facebook to ramp up, and it's still only at a low six-figure run rate right now. So, let's not get too far ahead of ourselves. Remember what I said. Always say it's better to show up in the second inning than to get rained out. All right? So, lots of positives, lots of things to be careful of. Don't go crazy, on this. Excuse me, in terms of panicking, because we got all that room for upside on this stock. I just want to see the day traders filter out a little bit, right? Which has been happening. So don't be surprised if Monday morning I come back and put that back as an official pick. Maybe next Friday, maybe the Friday, who knows, right? So panicking out of this stock is not the right thing to do. Just be mindful of that. Love that. Love this name. There you go. By the way, $6 price target by H.C. Wainwright. Stock at 569, so we're below that price target. I expect price targets to be increased on the heels of this great quarter, so stay tuned for that. Let's keep moving. On the opposite side of the spectrum, okay, whereas I saw that move to, how far did it get to? IDN got up to $7, okay? IDN got to $7. That was too much of a move to me. Now it's back down to $5.75. That's a big move down from $7. We're talking about 18% haircut off of that. Curiosity stream, meantime, this move here, totally justified. This was not a 50% move. This was a 30% move. Much more manageable, especially considering what was happening to the stock. The stock was down 50% going into this earnings call. That was too much. Now what you saw here, look at the difference between IDN, right? IDN went from these levels and then regained those levels on the back end of this quarter. Curiosity Stream, nowhere near that. If Curiosity Stream had bounced to $7 on the quarter, I'd be making the same comments about Curiosity Stream, but it didn't. Okay? In fact, the move that it made, not being enough, in my opinion, I'll explain why, got faded really quickly to the point where the stock is now down 13% off of these levels. So we didn't get the same pop, but we almost got the same drop. Wrong move. This is one of my juicy buys of the week. And why? Pull out my notebook. Again, hey, for those of you who don't watch the show and are new to this, your two biggest investments, a pen and a notebook, because the brain forgets literally. Trust me, unless you got a photographic memory, your brain forgets 99.999, scientifically proven. 99.999% of everything that goes in one ear eventually comes out the other. We can't help it. The brain is a processor, not a hard drive, okay? So we need a hard drive, pen and paper. My pen and paper tells me that On the earnings call, Curiosity Stream told us that not only did they just have a great quarter, but their anticipation is that their existing customers, these are hyperscalers, okay? AI hyperscalers. For those who don't know what Curiosity Stream does, Curiosity Stream historically has been a content provider, video content, think movies, right? Boring business. But once AI got lit up, now you start seeing what is happening out there with all these AI videos. This is relatively new, right? You're just starting to see these AI videos pop up everywhere. Well, guess what? And some of them are like, they're wonky, right? This is not perfect. It's really cool. It's really impressive, but it's not perfect by any means or by any stretch of the imagination. And the hyperscalers know this. So what are they doing about it? They are continuing to train their AI models. Sorry, just placing a trade here. Wanted to buy some of these things here. They are taking more video content, licensing that content, and putting it through their learning models. Okay? So that the LLMs, these large language models, can learn better how to create videos. Go watch yesterday's video for more information on that. But that's what Curiosity Stream does. And what they said on the call, which I didn't tell you yesterday, is that those existing customers alone are going to grow 60% next year. In other words, this wasn't a one-time thing, and I told you that, right? That was my first concern. This is going to be a one-time licensing thing, and then poof, that's it. No more. Insatiable demand for real video content to train AI on how to make AI video content. I've already seen an AI-generated commercial on a nationally broadcasted football game. You know what this means for the ad agencies who hire multi-$100,000 a year people to create like Super Bowl ads? Devastating for those people. And in fact, I've got recruiting contacts, and a recruiter called me up and said, yo, you're spot on, Mark, because we're seeing those guys that make those Super Bowl ads hitting the streets. They're getting fired. They're getting canned. They're losing their jobs because AI can do the job. All right? But it can't do the job as good yet. So on that side of the equation, those big ad agencies need fewer resources, not zero resources, but they're working in that direction. Because guess what? Using Grok to make a video right now costs $0 for me to make a few second video. To make a commercial might cost a little bit more than that, but certainly not hundreds of thousands of dollars a year. So get rid of the human help, and in comes the AI help. I know we don't like it, but we can't help it. You can't stop progress, so you might as well profit off of it. Okay? And that's what we're doing with Curiosity Stream, because not only are they going to grow those existing customers 60% next year, but they're going to have a doubling or a tripling of the number of companies that they're dealing with on this front. And they're serving as a broker for other content providers to license their content to the LLMs, to the hyperscalers, to the Googles, to the Facebooks, to the Groks of the world. These guys are making moves in the heart of what is one of the most exciting parts of AI right now. And people faded this move. Why? Because they don't know how to do the math. They don't and I can't blame you. You got better things to do. You got your own careers, but how are you going to make moves in a marketplace without knowing what the math is? I drew these lines for you for a reason, okay? These are technical lines, by the way, but until further notice, this 200-day moving average should serve as support. This bottom line should serve as support. And the reason being is that we've got them, if you do the DCF analysis, with a valuation that should be $8 or $9. The stock's at at 4 right now. The stock should be $8 or $9. One proof point to that, in the quarter, by the way, they give a dividend out, by the way. It's crazy. So you got a cash dividend that comes with the stock as well. But they also gave us free cash flow. Okay, and free cash flow is like the gold standard for a DCF analysis, and a DCF analysis is the gold standard for figuring out what a stock should be worth. Not what it's going for out there, not what the traders say, not what the chart says, but what it's actually worth. And that's what made Warren Buffett the richest man alive. DCF analyses. So the free cash flow that this company generated in the quarter was 8 cents. 1 quarter. 4 quarters equals a year. 8 times 4 equals 32 cents. That means that this company right now, without that growth that's expected next year, they gave us 46% growth in this quarter. They're going to give us 60% growth in their install base next year. So obviously that free cash flow should continue to rise because licensing is a high margin business. The profits drop straight to the bottom line. Okay? And just based on what they're doing now, never mind the growth going forward, they're only trading at 13 times their free cash flow run rate. Ladies and gentlemen, when a company is growing at 46% a year, it generally doesn't get a 13 multiple. Even Kramer will teach you that. It's called a PEG ratio. Usually a PEG ratio is 1-to-1. Okay? So all else be, and I'm not saying that the ratio should be 46. 13 is too low. 46 would be too high. But something in the 20s makes sense, and that's where you get yourself to $8 or $9 per share. The stock is undervalued. I own the stock. And I'm tempted to buy more. I've been looking for opportunities to do so, but the show came up, whatever. In fact, let me see. It's so funny because I haven't even really had breakfast yet today. I just put whatever I could find on the kitchen counter down my throat. Pause. What do we got here? Curiosity stream. Can I own more of that? Yeah, I can own a bit more of that. I shouldn't have said anything before. I'm gonna buy a little bit of this. All right, round that up, put some bids in here. Okay, and that's Curiosity Stream. If you have any questions, put that in the queue. Oh, it's time. I told you this is in no particular order, and when I look forward here, I've got some things that are like, the stock that I bought the most of is still to come on this show. The stock that I bought the most of this week is still to come on this show, so stay tuned for that. But we're just taking everything in order of where I put it in the queue for today's show. So let's see. TSSI. The stock I gave you, we already went through the preamble at the beginning of this show. I told you as a buy at 2, a sell at 20. Hopefully you got back in when it was closer to the green line. It got back to 20. It was a sell again. And it continued to 30. And I told you, don't worry about it. I don't care. I don't care what day traders do. I don't care what the public does. Because 99.9% of people have no idea how to analyze or value a stock. And when I came out here and gave you that bombshell article, not article, it was a special edition of this show. Let me pull it up for you so you guys can find it yourselves, because it's very important. If you care about TSSI and you're wondering what to do with TSSI stock, you're going to want to watch. Where is it? Right here. Okay? Revealing an AI bombshell. This is from 2 months ago. All right? And in that bombshell, I told you that Dell had retrofitted a facility in a town where I used to live, so you know I got contacts, and made a facility for AI rack integration. Oh, that sounds familiar. Oh yeah, that's because that's what TSSI does. And oh, wait a minute, TSSI does rack integration for Dell. So what happens when a company that relies on another company, right? TSSI relies on Dell for 97% of its revenue. And then that customer, Dell, decides to have a facility that is 3 times larger than what TSSI has. I told you that was a giant yellow flag. That Dell was putting themselves in a position to either disintermediate or squeeze the margins of TSSI. I'm going to show you proof of this in their model in a moment, right? But what ended up happening is over the last couple months, that episode of Stock Talk Live was right about here. There we go. Right about here. And the stock is now down 55% since that time. I didn't tell you to short it, but I told you I wanted nothing to do with that at these levels because the risk reward said so. But how about now? How about now? Because now we are much lower in the risk reward range. Let's go over the numbers. You don't need this press release for that. What I want to do is let's pull up, and I should have done this ahead of time, but this is quick fix. We want the TSSI model, and I'm going to show you my numbers for next quarter. Here we go. First of all, the numbers for this quarter, September. What I have next to it, let's blow this up so you guys can see it a little bit better. Boom. All right. There's my model going way back, right? And this is what helped me tell you to buy it at 2. Helped me to tell you to sell it at 20, right? And what we have here is this column right here is what I was thinking was possible, okay? And a lot of you remember me telling you, I don't like this setup, this company setup, but there is a good chance that they give us a great Q3. A chance. I wasn't making a call. In fact, I was very specific in saying this is not a call, but this is a possibly tradable event. And in fact, I myself bought a little bit of it. You know, like putting 20 on the Patriots game. I put a little bit of money into it, right? And by accident, I sold it before they announced earnings, thank God. Because I expected, like, I thought I had lost money. I went into my portfolio and the shares were gone. Turns out I had blown it out by accident. It happens. Sometimes I make a mistake that helps me. Sometimes I make a mistake that hurts. But that notwithstanding, these are the numbers that I thought they could do. It wasn't a call, but this is what they could, and if not, should do based on the federal year end, the amount of AI racks that were being integrated, etc., etc. So let's go through and see what happened. By my estimates, the facilities revenue was better than what I expected. I put in my model 1.3 million. Oops. 1.3 million. They did 1.6. Okay, great. The problem is this is only like 4% of their revenue. Doesn't move the needle. Here's the big problem. The integration, the rack integration. Getting those AI servers, putting them into these refrigerator-sized boxes and shipping them off to Elon Musk, etc. Okay? And you can see, when I first picked the stock, they were right around 2 million, 1.6 million, right? And that ramped up to 2, to 5, to 7. And then it flatlined at 7, 7, 7. Why? Because they needed a bigger facility. They opened the bigger facility. Then they give us a 9.5. And they should have been able to give us a 12.5 in this quarter. But instead, they took a step back. A step back. AI is going full guns. CapEx is moving up. Google, Facebook, everybody raising their CapEx numbers. So these numbers should have gone up. It didn't. They went down. There's decent reasons for that. It's not all their fault. It's not all Dell taking business away from them. Dell wants them to integrate into their software systems, etc., etc. We got new racks, new servers, whole new architecture, Blackwell, right? And that has new implications for what TSSI's capabilities need to be in their facility. They didn't have those capabilities ready yet. This is a problem for the future as well, because what happens when the next iteration of NVIDIA chips comes out? We're going to be past Blackwell soon, okay? So that is a problem. But they said that the problems have been resolved and that next quarter is, not should be, is going to be much stronger on the rack integration side, okay? So there's that. Procurement. It was a federal year end. They put up a 90 ball in the March quarter. They put up a 60 ball in the September quarter. I thought if you put up a 60 and a 90 ball back then, you should be able to put up a 90 ball in this federal year-end quarter. 30. My eyes are watering. I need some hydrogel. 30? Bro, that's horrible. It's horrible. Now, luckily, that's only a 7 or 8% margin business. If we go down to the gross margin, I don't want to bore you all to death. So we're going to speed this up, right? It's only an 8% gross margin business for them, all right? So we don't need to panic on that. But if you get 8% of 30 million versus 8% of 90 million, that's a lot of money that did not drop to the bottom line. Okay? And as a result of those revenue numbers, right, we move to gross margins real quick, and then we'll be done, right? Here's the biggest problem of all. Their integration numbers, which have traditionally been, and these are real numbers, so I can get rid of the italicizing and make them black. Those are real numbers and not just estimates. They've been putting up mid-40s gross margin numbers. And I told you that those were juicy numbers that are going to attract competition, including from Dell, because Dell only gets gross margins of 17% on their total business. So why would they let somebody else run away with 44% gross margins? They want to do more of that themselves to raise their gross margins. And on their last earnings call, Dell said so. Okay? What do we get this quarter? 13. Fell off a cliff. Not only did revenue drop, but margins fell off a cliff. Now, part of that's because of the utilization rates. They have a big facility, but they weren't prepared to utilize it because of the software integration, et cetera, that I already told you about. So that's going to rebound. Will that rebound into the mid-40s? I don't know. I put in my model 37. That's a healthy bump. That's more than halfway from 13 back to 44. Okay? And there's a reason why I put that number in there. The reason is that I wanted to kind of see where Wall Street is coming from on their current estimates for next quarter, which is 50 million and 10 cents. And this is what you guys care about, right? How are they going to do in Q4? And is the stock a buy right now? Let's talk about that and stop talking about boring accounting. In order for them to do 50 million next quarter with 10 cents on the bottom line, my model says that rack integration business has to go up to 15 million. A big jump, okay? I'm not saying they can't do it. Management, it's halfway through the quarter. They gave us some guidance. I believe them. It's good management, okay? I like these guys as people, and I like them as managers. There's just certain things out of your control, though, when 97% of your business comes from one customer. Back where I come from, that's called being somebody's bitch. That doesn't make for great stock investment, okay? There's a lot that goes into this 15 number. I don't know if they can make it. I'm not saying they can. I'm not saying they can't. I would bet on them being able to substantially increase the 9, but they didn't say it's going to be 15. They said it's going to be a substantial increase from the 9. Procurement, I put in 35. Why 35? They've got a rebound off of this number, but there's a problem, right? There was a government shutdown, right? That probably impacted this number. So some of that moves into this quarter, right? But they did say that the first month of the quarter was not a good one for procurement. So can they make up for a bad month in the final 2 months of the quarter? We'll see, right? And then we have to have the margins rebound on the procurement, on the integration side. And if that happens, then we can get a 10-cent quarter. Now, what does that mean for the stock? Well, a 10-cent quarter, I mean, they've already put up numbers like this before. We're not showing much in the way of growth. Okay, so you can't put a big multiple on one, a company that's not growing very fast, their bottom line numbers. 2, gets 97% of their revenue from one customer, which makes them their bitch. Right? And even if they put up that 10 cents, 10 cents times 4 quarters is 40 cents. The stock's trading for $8.66. It's still, as we speak, trading at a PE of above 20. I gave you Curiosity Stream trading at a 13 multiple on current numbers. We got TSSI trading at 20 plus times what we hope they'll be able to do next quarter. If we base it on what they did this quarter, well, forget it, because it's a -6. You can't multiply that by any number and get a positive number to give a PE to. So I'm not inclined to get in the way of this, ladies and gentlemen. And the main reason is because I can't say that this is just a rough patch. right? In most companies, when you get a VTSI, for example, I believe that what they're going through is a rough patch. Every company goes through them. Look at this rough patch. It was a buy. Past rough patches. I don't know if you could see it in front of my big head, but this was a rough patch. It was a buy. This was a rough patch. It was a buy. And when you buy VTSI on a rough patch, if they come out of it, your returns, that was a 472% profit that you made by having the guts. And it's not just guts, it's the knowledge that the company wasn't crashing, it was just going through a rough patch. That the long-term fundamentals weren't at risk, it was just a rough patch. With TSSI, I do believe that the long-term fundamentals are at risk, and that is the video that I shared with you months ago, right? And that is proving to be the case. We're seeing continued risk in the model. Now, what can they do to change my mind? Can they change my mind? Sure, of course. Number one, don't be Dell's biatch. You need more customers. You need to expand out. You cannot be beholden to whatever Dell wants you to do. If Dell decides they want you to do X, Y, and Z tomorrow, because let's face it, they wanted you to do ABC last quarter and it killed your quarter. What happens if they want you to do X, Y, Z this quarter? It's going to kill your quarter because you're their biatch. I don't like that as an investment strategy. I don't like investing in biatches. Back here it made sense because the stock was cheap enough. When the stock was 2 and they were the only game in town and Dell didn't have a facility 3 times bigger, 6 times bigger than what TSSI had at the time. TSSI was the only game in town. Now they're not even the biggest game in town. Dell is much bigger, brought a lot of that in-house, and they have attracted other partners besides TSSI. Why? Obviously, because this is what Dell does. I've been covering Dell since the 90s, ladies and gentlemen, and what Dell does best is to make sure that they squeeze every drop of profit out of their business so that they can have the best market share out there. They're the AI darling when it comes to AI racks. Why? Because they do it more efficiently, cheaply than anybody else. Because they're willing to accept those 17% gross margins, not 45. If you're Michael Dell, whoa, what are we going to do about this company that's getting 45% gross margins on rack integrations of our servers? Let's squeeze them. Let's bring in our own rack integration. Let's get more partners in place. That's what we don't know for a fact. Well, we do know for a fact that that's what's happening because we've seen that in the marketplace. Now, whether or not that impact continues, we'll see. But be careful. I would rather wait until the stock gets closer to the green line before getting involved, because not only is it still in the middle of the risk-reward range, they do have a business model that is at risk, in my opinion, and they have broken the technicals in a big way. They got to the bottom of the technical range leading into earnings and crashed right down through it. It's going to be a very hard road for them to regain that channel, okay? And a lot's going to have to go with it. I'm concerned, okay? I'm not bearish. I really am hoping they get this together. So don't confuse me keeping it a buck, telling you the truth of my analysis, with me not liking these guys or being bearish on the company or the stock. I love these guys, right? And I feel like I'm sad because this is the analysis. I can't change it. And as a result, I don't even feel comfortable calling these guys, right? I know plenty of people that do. I get plenty of analysis from the outside world of people. I know a lot of people that speak to management, so I get information from them about this. Not from all of them, so I don't want management to cut those guys off, right? And I'm not saying they've cut me off because they haven't. I just don't feel it's fair for me to be giving out this kind of analysis and then asking them to spend their time with me, because that time is not going to change anything based on the information I have out there and based on the information being fed to me by my contacts who speak to management. So we have all that information. It's just not adding up. If you have any questions, put it in the Q&A. We will get to Q&A shortly. By the way, if you like what I do, right? A dude that lived in a basement for $143 a month that became a multi-millionaire, making 7 figures a year in a penthouse in Miami Beach, and still decides to give back to society because my mentor is the reason why that happened. The reason I'm not homeless and am in a penthouse is because my mentor shared his time with me for free. I'm giving you my time for free, and all I ask in return is that you share the word, spread the word, give me that thumbs up. That triggers the algorithm. Put a comment in the chat. That triggers the algorithm. You don't have to hit the subscribe button. You don't have to hit the notification bell. But if you don't do that, then you're going to miss things like what I gave you yesterday. It was money making. You saw the stocks move on the analysis that I provided. I'm not saying that it was my word that moved the stocks. No, it was the realization that that analysis meant that those stocks should be higher. Okay? Thumbs up. That's all I'm asking for. Let's keep going. Put any questions about TSSI in the chat. We got a lot more to talk about. AI, etc. My favorite picks. Q&A is going to be late today. We're going to go into the lightning round when it comes to the rest of these because I know we've talked about some of it yesterday. And so you can go to yesterday's video for some of this stuff. IZEA. Where are we at right now? This is what I believe to be a great evolving company. You should go to my blog site because at that blog site there is this article right here. IZEA's turnaround has created a risk-reward monster. Nothing has changed since that article came out. And as you remember, when I put out this pick, the stock immediately bounced or jumped because it's a relatively low float stock, right? And when people see a strong analysis, they see value, they jump on a stock. I said, don't chase it, right? But now we're seeing an opportunity, right? On this pullback, stock's only up 30% from when I picked it. They've got $3 in cash. The stock's at $5. They have $3 in cash. That means you're only paying $2 for the stock. Okay. What did they do last quarter that they just announced? They transitioned their revenue from companies you've never heard of doing one-off projects for them. Non-recurring business with crappy companies, in other words. That's what they were doing before. And losing tons of money on that. They did $8 million last year with those crappy companies and spent $16 million delivering those services. That's an $8 million loss. That's not good business. So management got kicked out, new management came in, and they got rid of all that bad business and still put up $8 million. But this time, it was from tier 1 customers that come back for more and more and more recurring business. The quality of this quarter's revenue was much higher than last year. You could put up 8 and go to 8 and have it be a difference. It's an apple and an orange. This 8 was crappy. This 8 was great because they were profitable on that 8 million. It's recurring business. So now all they need to do is keep growing those accounts and they will be able to grow that revenue. What accounts do you ask? Quite simple. Just go to the highlights part of the PR. They produce new work for existing customers, including Kellogg's, Clorox, Nestle, Danone, the yogurt business. They also have done the F1 movie, the Superman movie, the Barbie movie for Time Warner. They're basically going to do all their movies going forward, it seems like, right? But not only that, they got new business from Owens Corning, you know them, Pyrex, General Motors, GM, you've heard of them, right? And Amazon. These are the types of new customers they're getting. They got Amazon. And why? Because they have a platform that very few companies have or can afford to create. They spent $40 million in R&D, $40 million in M&A to put together this platform that enables them to have 1 million social media influencers that have opted into their database, right? And from those 1 million social media influencers in their proprietary database, they can determine who, based on their profile, their geography, etc., which ones are perfect to advertise the F1 movie, to pimp the Superman movie, to give social media influence for Amazon, General Motors, Owens Corning, Kellogg's, Clorox, Nestle, Danone. They find those best influencers. And with the F1 movie, they found the best 250 out of those million, contracted them, coordinated with them, orchestrated a social media blitz, rushed the red carpet event for the F1 movie, and created a major social media buzz. Got F1 trending on social media, which contributed to the success of F1, which brings me to the last part of the platform. Not only can they manage all that, but they can measure and map the success, the value that they provided to those customers. And when those customers see that value, that gives them the wherewithal to come back and say, do it again, do it again, do it again. Okay? So what we have so far, now listen, I'm not here to say that going from 8 million to 8 million is great, but I'm here to tell you the difference between that 8 million and this 8 million. Now we got to see them figure out how to grow that revenue, get rid of the rest of the garbage, right? You see Oscar the Grouch in the thumbnail, and grow that base of business from all these tier 1 customers. They need to do that. Do I think they will? Yes. Because they've done this before. They were with Leo Burnett. Look them up. Leo Burnett is a legendary ad agency. They invented the Pillsbury Doughboy. They invented the Marlboro Man. All right, legendary firm. These bigwigs came from that firm, joined this little company. And I'll tell you this. I came from big companies. IDC, over $100 million company. AMR was acquired by Gartner Group for like 50 million bucks. And I formed my own company. Right? A big fish at a big company, moving to a little company, and it was really easy for me, coming from a $100 million company, to build a multi-million dollar business. I didn't create a $100 million business, but this guy has, okay? And you don't have to. If these guys just grow this 8 million to 10 to 12 to 14, then you're going to see tremendous profit dropping to the bottom line, thus justifying this risk-reward chart. This risk-reward chart is basically the manifestation, the personification of the math that I've done on what these guys are capable of doing based on what I've seen here. Don't go ham. Don't be bidding the stock up 50% or anything like that. Just know that in the low fives, this, in my opinion, is a great buy. And you can let the shares cycle, right? People who chased it to $6 had the opportunity to buy it at $5 and even into the 4s. I thought that was a little aggressive. Now we're in a good place. And, right, we can move from there within this channel. All right, so that's them. Questions, comments, put it in the queue. Virtual, we're going to go real quick on this. Bottom line here, this looked like a horrible quarter on the surface, right? Because here were the numbers. 5.3 million down from 7.5. That's a 30% drop in revenues. Oh my God, it's horrible. Not so fast, dummy. Bookings. Bookings, it's all about bookings. The bookings were 8.4 million. That's their best bookings quarter in 3 quarters. Their 6th best booking quarter ever. It shows some signs of life that maybe these guys can start to get off the mat. All right. No guarantees, by the way, but we're right near the green line. And what did I tell you about a company whose business model is not at risk? And I do not believe this business model is at risk. What do I tell you about this? A stock like this that is sitting near the green line? It's worth your money. Not only for the fact that the existing business is showing some signs of life again, but also because the IVAS program, IVAS, that helped this stock do this back here is alive and well again. Thanks to one Palmer Luckey. If you haven't heard of him, you should have by now, because he was the reason that Kraken went berserk. You remember Kraken, the one that I gave you at 70 cents that went to $7. I was out by then. Oh no, not $7. It went to $5. Sorry. It was only a 7-bagger, not a 10-bagger. I got out after it was a 3-bagger. Why? because it was too expensive at that point for me. But I remember I told you that this was the one company that I thought I cannot raise the red line because I don't have the expertise, but I'm afraid I'm missing something here. And it looks like I was, because that stock kept going, although it's pulling back now, right? Palmer Luckey is the CEO of Anduril. And when they go public, Anduril, it is going to be one of the hottest IPOs of the year. So get to know them. All right, they are the Tesla of the defense industry. Okay, and they made Kraken take off because Kraken batteries go into the autonomous submarines, AI-driven submarines, unmanned submarines that Anduril creates. That has helped Anduril become the private market sensation, the unicorn that they are. Okay, similarly, you got VTSI. Palmer Luckey recently did a video. You might be able to look it up on YouTube regarding the IVAS program, and it was sick. It was absolutely sick what he is going to put into these goggles. He's going to basically turn our soldiers into supermen in terms of what they're capable of seeing. It's like video game level stuff being incorporated into those goggles that the government wanted back here when they, in their infinite wisdom, put Microsoft, of all companies, in charge of the program. Microsoft failed. Palmer Luckey is not failing, and in fact, he's moving way faster than I expected in getting that job done and redone. And he said in that interview that you can expect these goggles in March. You can expect to see them complete work on the first iteration of these goggles that the government wants so badly in March. That's only a few months away, right? 4.5 months, as a matter of fact. And as that IVAS program finally starts to take off again, as it was supposed to back here when Virtra was $12 a share, Virtra is in great shape to supply the recoil kits. I've talked about those before. You can look it up, Virtua recoil kits. To save time, I'm not going to keep talking about it because you veterans already know it's in your notebook, right? And that has the potential to be a 8-figure business for them, dropping tremendous profits to the bottom line. 8 figures, ladies and gentlemen, is over 10 million. They did 8 million total bookings in the quarter. Okay, so there's Virtra. Let's keep moving. I said it would go into the lightning round here. SenesTech, they're still in developmental phase. I think they did fine in the quarter, but I told you this is a speculative stock, and we're in a yellow alert. If you've learned the lessons, if you read the article, listen to the spaces, and watch the video that I talked about at the beginning of this live, those are things that I made for you. There's no tricks. You're not going to read it and at the bottom say, subscribe to Mark's newsletter. No, it's for you. It's actually for my friends and family, but I put it in the public domain for you. I made it so I wouldn't have to explain myself a million times to my friends and family. But you get to access that too, for free. Do it, or you're not going to get your questions answered from me, because that's lazy. I'm not lazy. I'm here to make money. Time is money. Bottom line on SenesTech, it's still speculative. They're making progress. The quarter was what it was. Neither bearish nor bullish. Progress. That's good. Progress is good. But it's still speculative. Very, very, very small position in my portfolio, like putting $20 on the Patriots. Oh, all right. I've been waiting for this. No, you know what? We're going to save this for the end. Because that, my friends, was my biggest buy of the week in my personal portfolio. And I'm going to tell you why. And we're going to cap it off with that before we go to Q&A. All right? First of all, Drone Shield. Remember when I took them off of my buy list? And, why are you taking them off the buy list? Why did you take them out of your portfolio? This is why, dummy. Because they reached the top of my risk-reward range. Oh, you dummy. The stock kept going, Mark. The stock kept going. Yeah, well, it ain't going anymore, is it? It's so funny. It's so funny because when I get rid of a stock from my portfolio, there's always going to be those unsophisticated amateur investors who don't have 30 years of experience and learning under a Wall Street mentor. 10,000 of them out there who don't have these credentials, who think that they know better. Dumb. Stupid. Okay, the stock hit this line right here and we were outie like 5,000. All right, the stock kept going. Big effing deal. I don't care. I don't care. Stocks become overvalued all the time. The problem is that 99% of people don't know if a stock is undervalued, overvalued, or fairly valued. I do, with more certainty than most because of my training. Only God knows for sure. But a trained professional comes as close to that as possible. So I didn't worry about the stock going higher. It was overvalued based on all my research, 100 hours of research on this name. And now it's coming out. Okay? Now it's coming out. What happened? The CEO blew his entire stake. 50 million bucks. Blew it out completely. Other insiders, 20 million more. And now you got hedge funds coming out here shorting the stock. All right? I'm not going to belabor the point, but it just goes to reinforce the lessons that I teach you. Okay? And look, this stock dropped 32% yesterday on no other news except for what I just showed you. After dropping back to within the risk-reward range that we got you out of way back here in July. And you know what that money has done since July? Our money has kept going up because we keep buying winners with that cash, not leaving it in high-risk situations. All right? Thought you guys needed to know that. Tech Precision, not a high-risk situation. Great move today on their earnings. What happened? Oh, I don't know if I've ever seen them, and I've been following this stock for probably a decade. I don't know if I've ever seen them earn 8 cents per share. How? How, Mark, did they earn 8 cents per share? Well, it's quite simple. Because of what I've been telling you. The research that I did. This is way over 100 hours. I might have done 500 hours of research on this name. Okay? They gave us 9 million, up from 7.3 the quarter before, up from 8.9 the year ago. Kind of ho-hum, right? But not ho-hum because they increased their margins and lowered their expenses to the point that they brought us 8 cents of EPS. So now they're profitable. And 8 cents times 4 quarters is a 32-cent run rate. Okay? If they can just put up 8 cents every quarter from now on with no growth, and I do expect growth. You can see it, these numbers here. I expect tremendous growth. I predicted that they would go from losing money to earning money before March of 2026. Well, guess what? Here we are. Better late than never. Right? A little bit late, but they did it, and in a big way with 8 cents. That's 32 cents annualized against a stock that's trading at $5. That's a PE of 15 on the current run rate. I expect them to move their run rate up towards $1, maybe $2, possibly $3 over time. If these guys get to a $1 run rate, the stock it's going to have to be double digits, if not 15 bucks, especially if the analysts see a line of sight to this kind of numbers in the future. Okay? So this was beautiful to see. Not much more to say. There's still more progress to be made in terms of bookings, in terms of clearing up that West Coast division, but they continue to make progress to the point where congratulations, they gave us another good earnings call, another good earnings announcement, and profitability. If you have any questions, put it in the queue. But I am impressed by what they gave us right there. All right, finally, before we go to Q&A, I got my notebook to go through real quick. Not much, though, just a few notes. But before we get to that, my biggest buy of the week, GeoDrill. This started out, let's go to the chart because you guys need to see what happened here. This is how you make money, ladies and gentlemen. The video that I gave you yesterday is how you make money. The analysis of GeoDrill's quarter is how you make money. Because on the surface, no pun intended, GeoDrill, it looked like a bad quarter. But as I explained to you yesterday, and I won't repeat it today, go back and watch yesterday's video because I gave a complete analysis yesterday, which gave you guys all you needed to know to be buying this stock. This stock was down at 330 Canadian I'm sorry, I cannot pull up the US chart. This program doesn't allow it. I'm going to request it again. But if you bought it at that price, the same percentages hold, right? 22%. 2-day gain, 22% on one of the safest companies in my portfolio. How? Because people panicked and sold out instead of buying. All right, and go watch yesterday's video to find out why they should have been buying and why this was a great quarter, not a bad quarter, as some people thought. The technical channel holds, the 200-day moving average held. I was a buyer, you were a buyer, everybody was a buyer. This is a stock to be bought. Why? Because right now they are trading at basically book value. This is a company that delivers profits year after year after year. When you are trading at book value and you're profitable, that means your book value will continue to go up. And all else being equal, in other words, if the stock market is just stagnant, your stock price will and should rise under those circumstances. But there's a funny thing here. Their book value is grossly understated by a couple of factors. One, they depreciate assets that they maintain at like new condition. In other words, the money that they invest into keeping these drills in tip-top condition does not accrue to the balance sheet, does not factor into the book value equation, because accounting, right? Accounting is BS. You need to understand the company. Accounting is just the best attempt to reflect things in financial statements for the SEC, for the government, for the public's well-being. Nah, bro. It doesn't work that way. Okay? Generally accepted accounting principles, GAAP, does not tell the story. And the story here is that their book value is actually closer to $5. So you are paying less than the value of their book value, the drills, right? But not only that, for a profitable company. So you're not paying for the customers, you're not paying for the management, you're not paying for anything. You're just paying for the book value of the company. Not only that, but that book value is $1 higher than it is on the actual books. Not only that, right? Because when I calculate $1, that does not take into account the fact that drills are right now selling at a premium in the marketplace to the point that the company is hesitant to buy anymore. Okay? But their customers are saying, go ahead and buy them. We'll pay the premium. All right? So what are they going to do with the cash? I don't know. They've had buybacks in the past. They've had dividends in the past. They have to do something with that cash, right? Dave Harper owns 40% of the company. So he has to do something with that cash. And if he's not going to buy drills unless the customer directs him to do so, which means that the customer is basically paying for it, that's not coming out of their cash. Their cash has to go somewhere. Okay? So we'll see what happens here. Dave has promised in the past that he was going to reinstitute, like the dividend, for example. Let's see what happens. I have no knowledge of that, but it only makes sense because that cash has to go somewhere. And by the way, right, all those investments they made last quarter, since then I have spoken, since yesterday's video, I spoke to management. And what I will tell you about yesterday's phone call, which is the update to yesterday's video, is that this quarter is going much better. Okay? They put the investments in place. That was bullish. And it's showing already in terms of revenue generation. October, higher. November, already trending higher. December should also be strong, if not higher, producing a higher Q4. Growth. Okay? And then Q1, Q2 should be a monster. So we got a good Q4 coming up, and then what looks to be 2 great quarters after that in a company that is trading for less than the value of its parts. And that, my friends, is why I made this my biggest buy of the week, to the point that Geodrill might actually right now, I don't know for sure, I know it was really close, because Gatekeeper, huge position, I've got some huge positions out there. Geodrill might be my personal largest position right now, based on those giant purchases that I made of the stock during the week. We don't need all that, because I went over a lot of that yesterday. All right, so we're ready for Q&A right after I give you the rest of my notes. I know you guys already see there's a lot of AI questions in the queue. You could put your questions in there, put a question mark at the beginning of the question, or I will skip your question, and then you're going to have to put it back in there the right way. And if we get to 355 and I haven't answered your question, you will not get your question answered because you were too dumb to put a question mark at the beginning of the question. Listen to instructions. If you can't follow instructions, how are you going to make money in the stock market? Discipline is A1, job one in the stock market. Having a pen, having a notebook, doing everything that I'm telling you, these are the things that my mentor taught me. I'm teaching you. And by the way, I ain't mad at it because for 3 years I didn't really listen to him. And I paid for it. And so now I'm telling you, don't be stupid like me. Don't be the dummy that I was. Don't be the loser that I was. Learn now the right way to do things so you don't spend the next 3 years losing money before you say, maybe I should get a notebook and a pen. Stupid. Let's see what we got here. My favorite buys of the week, Curiosity Stream. Crescendo. Got nothing to say about it except for the fact that there's no way the stock should have done this week. But the market is down, and that gives us the opportunity to take advantage. This was the right move. This was the wrong move. This stock should be going up, not down. Okay? This stock, I believe what we had here was just kind of a little head fake. The stock finally broke out of this wedge that's been forming for over a year. Do you know what happens to a wedge that forms for a year and breaks out to the upside? It goes cuckoo. Generally speaking, okay, but the market didn't cooperate, and this dragged crescendo down with it. But now we're back down to basically the 200-day moving average, right? We got support from this wedge. We got support from the 50. We got support. We got all that. Let me zoom in so you can see all that support. We have all this support right here for the stock, and only thing that's holding this thing back from taking off is this top line of the consolidation channel that's been forming for, how long has it been? Almost 2 years. This thing is about to blow the doors off the joint. Hopefully, I'm not God to know, but their fundamentals are great. They hit 7 million users. They're still stealing business from Cisco. They're still stealing business from what used to be Microsoft until Microsoft gave up and said, we can't compete with these guys, sell the business. All right, so this was one of my buys of the week. Curiosity Stream, one of the buys of the week. Crescendo, one of the buys of the week. Geodrill, just talked about it, one of the buys of the week. And by the way, GKPRF that I already talked about, this is one of the buys of the week because we got a nice pullback off of, whoop, we didn't want that to happen. We wanted this to happen. Come on. There we go. All right. Bouncing off of that bullish raise, didn't keep going because the market hasn't been cooperating. That provides you with the opportunity that you might have missed the first time. I told you the stock would pull back to the $1.49 deal price. It did. I backed up the truck. Look at all that volume. A lot of that was me, right? And you saw the stock taking off, but it didn't continue because the stock market wasn't cooperative. These are opportunities. When the stock market takes good stocks down, those are your opportunities to buy those good stocks. Remember back in COVID when I gave you Amazon. The market, look what happened. This was one of the craziest things I've encountered in the stock market, right? Is when COVID hit, right there. We can zoom in on that. This is a great lesson for you. You guys want to make money, you're going to make money right now. In the future, you will make money off of what I am about to tell you in 30 seconds. Right here, COVID hits. Okay? Amazon stock drops 25%. The market was down 30. Amazon's down 25% when COVID hits. Did that make any sense whatsoever, ladies and gentlemen? Because while we were sheltered in our homes, while we were sitting in our apartments and houses, not leaving to go to the grocery store, to go to Target, to go to Walmart, etc., 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 who was delivering our food, our goods, our toilet paper? Amazon. COVID was the best thing that could happen to Amazon, and the stock was down 25%. Why? Because the market was dragging it down. It was the wrong move. I played options on Amazon, and you see what happened next. Amazon, the giant Amazon, was up 114%. You don't every day see a mega cap stock grow 115% in stock value in just a few months. How many months was that? It was just 5.5 months. This, my friends, is what happens when you know the difference between a good stock and a bad stock, and a good move and a bad move. The market will drag good stocks down, and that is your opportunity to buy. Okay, so those are the buys of the week. I told you about IDN. Good Lord, Gartner and Forrester will have to wait till next week. VTSI, I told you about already. Rare earths, I promised something on rare earths because people, what about Aclara? ARAF, I'm down on Aclara. What about them? Bro, I told, like, you guys don't even know the rules. I told you I tell you what I know when I know. So you never, I hope there is not one question in the queue that says, what about XYZ? What about them? What's your question? What's new? I'm here to tell you what's new. What's your question on what I told you? Stupid, you're going to get the dummy treatment. Aclara, MP, who else? US Antimony, all down. Rare earths are down. It has nothing to do with these companies as individuals. It's that rare earths got super hot. I gave you some names. I told you when MP took off that it was better to move into ARAF. It was. The stock outperformed, right? But then it went cuckoo, and then it just became a trading stock, and then the channel broke. You see the technicals here? This zoom in. We can zoom in more. There, you see this nice upward channel. Look at that break. You see how the 50 is curling back down, and it broke through the 50, tried to regain, and now it's resistance. The rare earth sector, not just Aclara, needs to regain this technical support. And it's come down partly because, well, what is driving a lot of this rare earths demand? AI. And what's happened to AI? Well, you saw NVIDIA. We talked about it earlier in the show, right? AI's out of favor. Rare earths are going to be out of favor. Crypto's out of favor. All of these high-flying things out of favor. These are trades. These are speculations, okay? I've said it before. I'm saying it again for those who've asked me, what about Aclara? It's speculative. It's not even a speculative pick. But I got feedback from you guys a long time ago. Mark, can you stop talking about the same 5 stocks every week and tell me more about the other names that you deal with? Let me make my own decision on them? Okay, that's what I'm doing. You like the show a lot better this way. If I give you this information and I tell you it's speculative, that it's a trade, that it's not an official pick, that means if you lose money on it, it's on you. Okay? And I made some money and I lost some money on this, trading it around. And that's on me. Big boy pants. This is not a pick. It's still a speculation, highly speculative at this moment, right? Because the rare earths play seems to have fizzled out. Will it come back? I don't know. If it does, I do like this play better than MP because everybody knows MP. Everybody's wildly raised the valuation of MP. I've got guys that are looking at this one. So if you want to play rare earths, this is a fine play on rare earths, but highly speculative. US Antimony, maybe a little less speculative and a little more fairly valued in terms of having less downside risk. But it's antimony, so it's not as exciting as MP and Aclara. All right, that's it for my notes. We are deep into the Q&A timing. We got 31 minutes of Q&A. Let's see what we got. We'll put TSSI on the screen since that was a whew. Let's see what we got. I do read all the comments after the show, by the way, so I appreciate all of you, Kevin, Chris, Nader, Shay, all of you guys that are putting Constructora, putting your comments in here, but we're going to go straight to the questions. Intermap, if they are still looking at uplisting this year, oh yeah, ITMSF. We didn't talk about their earnings. Their earnings stunk, but they upheld guidance for the year, which meant that all the revenue that they were hoping to, that maybe we were hoping to get in Q3 is still going to be had in Q4 if they hit their guidance. Will they? I don't know. But here's the funny thing. Before we find that out, we're going to find out if they won the major mega deals in Indonesia. And that makes this, at the moment, a highly speculative situation. Okay, this has been a pick, and it remains a pick in my portfolio. But for the next couple of months, it's a bit speculative. We're up 325% on this name. Okay, big winner for us, right? But it's come down quite a bit. So listen, y'all. If you stayed in it this long, you could see the stock's up today despite yesterday's results. That's because people were probably waiting to get these quarterly results out of the way so that they could play the stock for the massive upside if they win in Indonesia. Will they? I don't know. I'm not God to know. But they are the incumbent. That means they are the ones that are doing the work in Indonesia now. The only ones doing this kind of work. So that puts them in the driver's seat. That gives them a good chance to win. But they could still lose. So that's where I say it's speculative to an extent until these deals are announced, right? But that's kind of reflected because the stocks come down 37% off of the highs, all right? As people get jittery about what's the result going to be. That takes a lot of the risk out of the equation. Now you got more upside, more reward. Just for the stock to get back to where it was, the stock has to go up 58%. The question being, if they are still looking to uplist this year, is their stock price high enough for that? What price do they need to be to list in the NASDAQ? Shay, great question. I spoke to the CEO this week. They absolutely plan on uplisting. That is their goal. Okay? So, and they continue to make that their goal for before year end. That's 6 weeks from now. Will they hit that deadline? I don't know. But if they hit it in 8 weeks instead of 6, is that a bad thing? Because all else being equal, uplistings are good things. It makes it easier for these stocks to be bought on things like Robinhood and Webull and all these kind of platforms that give you limited access to these big winners that I've had, which is why I've told you in the past, and this is not a commercial, my favorite brokerage firm is Power E-Trade. They're not paying me. They don't know I'm talking about it. I'm here to help you. And to help you, I'm telling you that to me, the best platform for buying stocks under the money mark way of making money is Power E-Trade. I have got like 5 brokers, but they're the one that I do like 90+% of my volume through because they give me the most access to all these stocks. Now, for all the other folks out there that don't have access to these stocks, an uplisting is going to give them access, and now you got a whole new slew of potential buyers. So that's part of the reason why uplistings are so good for a stock. Good question. Let's keep going because I'm going to have to speed it up here. We'll have to go lightning round soon enough. Mark, I heard on the show you speak on Mondays. Their guest was the Mob CEO. Oh, yeah. So if you follow me here, Money Mark Stocks, every Monday I am a guest on the Wolf's Financial Spaces. Wolf Financial with 600,000 followers. We get hundreds of viewers on the Spaces. If you don't know what Spaces is, just click on this play recording button. You'll experience what a Spaces is. This is a recording of a Spaces. Every Monday we have a live Spaces that Wolf Financial hosts at 1 o'clock. I am a guest that's brought onto that show. And if you follow me here at Mark Holmes Stocks and has the notification set up, you will be notified when I go live on that show, or if at all on my own. Okay. The question was, the guest was the MOB CEO, a stock whose I gave you as a potential pick way back around here. And it went way up to here, right? I wasn't here for the whole ride, but you see where I put my lines. So that has worked out really good for everybody. The question being, wondering if you listened to his Q&A and what you thought of it. Listen, I think this stock has gotten ahead of itself. They've got a lot to prove. In my estimation, the MOB CEO has gone from being secretive to promotional. I don't like that. Okay, they are still a small player. They do have a great opportunity out there. Okay, because all of these drones need the software and the security go in them, and MOB provides that security that goes into these drones, but they are a small player there. They are not the best player there. And that's why in doing my research, I consult with seasoned, third-party, multi-decade industry experts. Because what do I know about drone security? Zero. I just know we need drone security. But what do I know? Do I know the difference between a company that provides real good drone security and a company that doesn't? A company that provides the best drone security versus the one who doesn't? No. So I have to go to the experts. And when I did my research, what I found was these guys are not the best. That doesn't mean they're bad. That doesn't mean that they can't make money. They're generating revenue. They have very good customers, right? I think Teledyne is one of them. That's a big, great customer to have. But there's a limit to evaluation based on what you have for customers, what you have for revenue, etc. And these guys just aren't fitting the bill right now. Let me see, Mob stock. We've got a $80 million market cap, right? And if you see against that $80 million market cap, what you're going to find is, bring up the detailed financials, only $3 million of annual revenue. And in the last 12 months, the revenue has actually declined versus last year's numbers. Okay, not only that, but their expenses are higher than their revenue, which means they are losing money. So if we go to the cash flow statement, you see they are losing money year after year after year. And if you go to the balance sheet again, you see that if we go to the quarterly, this is a problem. This is a problem that they haven't solved yet, in my opinion. We need more revenue. We need more revenue growth. We need more cash on the balance sheet, because every time they bring more cash on the balance sheet, they burn through it. And you can see that in the cash flow statement. Cash flow from issuance of common stock. Issuance of common stock. Every quarter. That's called dilution, ladies and gentlemen. When you need money because you keep burning through it, that is called a bearish raise, not the bullish raise we got out of Gatekeeper. All right? So be careful with this one. I am not a big fan of Mobilicom at these prices. Let's keep going here. On the Curiosity Stream call, somebody asked why they don't exclusively focus on high margin licensing. What's your take on this? My take on this is you're not the CEO. And I'm not talking to you. I'm talking to the person that asked that question. The CEO knows this business. The CEO knows a lot about this business that he cannot tell us, because the utilization of that video content that he's licensing out to these hyperscalers is proprietary to those hyperscalers. So, come on, y'all. The CEO's look, could I be the CEO of Curiosity Stream? No. I mean, I could be, but I wouldn't be qualified to. This guy knows what he's doing. He's been running a great ship. He knows what business he should take and what business he shouldn't. Okay, the high margin licensing, just like you talk about with IZEA. That CEO decided to get rid of the lower margin business. This CEO's keeping some of it. That's his decision, because if it's profitable and doesn't detract from other more profitable business, then it's still good business. All right, that's my take on that. Meta chart, bro. You don't need the meta chart. I've already taught this. I don't want this anymore, all right? Because you obviously haven't taken notes, but I haven't seen you in the Q&A before, so I'm not going to yell at you. But for the mega caps, you can draw your own risk-reward lines. Just draw lines over the tops and under the bottoms, and you've probably got yourself a risk-reward channel. Because that's what mega caps are, mature. Wall Street is all over them. There's 100, literally over 100 MBAs on Wall Street in New York in three-piece suits on the 30th floor of tall buildings, being paid hundreds of thousands of dollars a year to analyze what Meta is worth. That is not true for my picks. That's why we have a big advantage. Because if 100 Wall Street analysts looked at all of my picks, I'm telling you right now, they would all go up immediately for probably weeks, because they would see the same thing that I see from their training, from my training. If the more people that see the same thing, the more the stock goes to where it belongs. And that's why these stocks go to a level where their risk reward ranges are pretty reliable to understand. And you can see here, even this line right here kind of follows the 100-month moving average, which supplies support for the stock, because long-term investors on Wall Street will buy the stock on dips because it's a closet stock. Don't ask me about these companies, these big companies. You can draw these charts yourself on those. TPCS, what's your take on the call? I already answered that. Margin going up. Yeah. Backlog 48. Anything you didn't like? Yeah, we talked about that already. So we're all set, Sergio. Good question. Regarding Isaiah, thank you, Sadat. Is that how you pronounce your name? Now you give me a good question. Marketing expense down 62%, but temporary. Yes, of course temporary, because as the company grows, they're going to ramp those expenses again. They've level set the business. That's cool. Operating expenses down 67%. Is this new baseline, or will they rebound in pursuit of their high quality recurring clients? Yeah, they're going to figure that out, bro. Here's the bottom line, and it's a good question. Here's what you can take to the bank. The CEO worked for Leo Burnett. Look it up. He also went, and his last company ran a company called Merge. And this guy has done over 20 M&A transactions. He built Merge up to a multi-$100 million valued company. He wants to do the same thing here at Isaiah. Okay, and he believes, based on his experience at Leo Burnett and at Merge, that he can generate 20+% operating margins here. Okay, so you're talking about operating margins, operating expenses. Obviously, the operating expenses leads you to what's more important, which is operating margins. So if you're building a model for yourself, take their revenue, assume 20% operating margins in the future, as that's what he's going to build it out to, and you'll start to see why I have my lines where they are on this right here. That's a really good question, which makes up for the last one, which I didn't really love, but it's okay. Why RWM and not SRTY? No reason, Nick. Right? Any RWM, by the way, shorts the Russell for you. Those of you who don't know what shorting is, right? You need protection against the stock market dropping. RWM, by the way, the market goes up over time. So RWM goes down over time. But when the market goes down, RWM goes up. Okay? So during COVID, RWM went up 60%. If you were hedged, if you saw COVID coming, if you listened to me when I told you, right? Because I saw COVID in Asia, and then my contacts in Europe told me that it was there. Italy was an absolute mess. One of my oldest friends was there and told me, dude, this is an absolute mess. It was easy to see. It went from China to Greater Asia to Europe. It didn't take a rocket scientist to realize that it was going to come to the United States. Last, but it was going to come. So you needed to short stocks. Do you know that the stock market kept going up 3 weeks after COVID hit? But it was only once it became headline news on CNBC that the market tanked. So you had plenty of time to buy RWM, right, for that orange alert, and make 60+% on RWM. Other than that, you wanted to be out because the market had tanked, and that was your opportunity to buy stocks, and you didn't need insurance. Your insurance was that the market was cheap. But now we need insurance again. So the question being, why not SRTY? It could be any. Oh, but see this, I don't like Ultra. I don't like Ultras. I don't like 2X, 3X. Those are levered. Levered ETFs have what I call leakage. Don't do that. You have to have great timing to deal with ultra anything. 2X this, 3X that. All these, no. Stay away from that stuff. That's gambling, okay? You want a 1X. And that's why I pick RWM. It keeps it simple, stupid. Hiss. In your view, how bad was the drone shield sell-off? Bad. He sold every single share he has. Did the market overreact? I don't know. But see, this is why I draw these lines for y'all. Because these lines are the personification of risk reward. Okay? So the answer to your question is this right here. This is the answer to your question, right? Was it an overreaction? I don't know, maybe, maybe not. But what I do know is that it brought the stock here, which is still way high in the risk reward range. Okay, do I want to pay this price? Do I want to give up this much reward? I mean, this much risk. Do I want to take on this much risk for this much reward in a company that the CEO just sold 100% of his shares in? No, no. I'm a newbie, hopefully not a dummy. Well, if you're a newbie, you're probably a dummy, but he is stupid, but he knows he's stupid, and that almost makes him smart. After listening to yesterday's show, I had this question. When you say this is a buy, do you mean at the current market price? Well, yes. But dude, go watch the video and tell me later. I want to know why not. I want to know the truth. Have you watched my introductory video, Make Millions with Mark? Have you read my introductory article, Get Rich on Stocks? And have you listened to Finding Multi-Baggers Like Mark on X? If you haven't, then you're asking me questions without having done your homework first. Money Mark, I did my homework and I have some questions. Okay, why not? What are your questions? I'll answer them. Why not? But not today. Air announced the shipment of their dual-edge burn-in systems. They mentioned evaluations for blah, blah, blah. Do you believe it is fairly valued or waiting for higher orders? It's just, this is what they're supposed to be doing, okay? And this is what we got right now. This is the risk-reward channel. We're still waiting for, right? AI isn't a gold mine. I told you that way back here. That was a great run we got out of it, right? It went very high because they're not operating on all cylinders. Remember, when you learn about these risk reward lines, this tells you where the stock, if the stock is operating on all 10 cylinders, this is where the stock belongs. So if Air was operating on all 10 cylinders, I would tell you that the stock belongs up here, but they're not. Why? They are selling more systems, but they're selling the cheaper system, not the more expensive system. We want to see more of that. We want to see more hard drive sales. We want to see more AI chip sales. There's a lot of opportunities, DRAM. There's a lot of these opportunities that they have out there, and they have hit some of them. We are at least in the second inning of this, right? We're not getting rained out, but we haven't seen the grand slam. We haven't seen the home runs getting hit. We don't see the kinds of customers I want to see buying the kinds of products we want to see for them. So the stock got ahead of itself. It's pulling back now, getting close to the 200-day moving average right now. And by the way, I don't love moving averages and stuff, but a lot of people do, so we got to pay attention to them. But here's the thing that I like about the 200-day moving average in this case. By the way, 200-day moving average is moving up as the stock moves down, so don't go thinking that the stock should go all the way down to 16. I don't think it should, because the moving average will keep rising, and maybe it converges with the stock at 18. You know, this one's at 20, this one's at 16, maybe they meet in the middle here. Okay, so I think there's maybe a little bit more room for this to pull back before I want to start putting my money back in here. Right? But what's nice about if it pulls back to this 200-day moving average is that we'll have only this much risk against this much potential reward. Risk, reward. All right, we're almost at 345, at which point we go to the lightning round. I'm not here to tell you about setting limit orders. Why not? You got to learn that for yourself. Ask AI, ask YouTube. I'm not here to be your teacher. No offense. Best food for staying fueled while day trading. Bro, there's no hope for you anyways asking a question like that. This is a professional show. I'm sorry. wasting our time. You're wasting everybody's time on that. Congratulations on the TSSI call. Report was disappointing, but this looks like an overreaction. I already went over it. If management hits their targets, it might be a buy here, to be honest. Have a good day and thanks for your work. That wasn't a question, AA, and I'm going to ban you from asking any questions. Hide user on this channel. I'm sorry, I got to do it. Okay? Because I need to make an example of some of you. I don't care if it's your first time. I said if you have a question. I've said many times before, don't pimp your stocks. This is my show. This is not your show. You come in here, put a question mark, and then make a statement. I go talk that statement because I'm reading questions. I think you have a question for me. You don't. You have a dumb opinion from your non-professional, non-30 years of experience point of view. I'm here to give you mine, not to listen to yours. Everybody's got an a-hole, but nobody wants to hear from them. All right? So I'm making an example this time. If you have something that you want to be heard, go make your own channel. I'm answering questions. You wasted our time, and now you are banned from asking questions ever again. And I'm sorry, you might not deserve that because it's your first time making that offense, but I need to make an example sometimes of people, and you're it, stupid. Mark, and by the way, if you are somebody who did the same thing, go back into the queue and delete your question before I find it. Because if it's not a question, I'm banning you too. Mark, are you able to comment on crescendos, shareholder voting? Votes are in December. Should we vote with the board? Yes, we should. Sinestech earnings. Yes, Nighthawk, we see a lot of dummies. Good comment. What did you think of their quarter? Was there anything about the results that made you concerned about their future? We already went over that. We're waiting. There's a long time before. Can you put up the chart for Iridex? That's a fine question. I've talked about Iridex in the past. I'm just not messing with Iridex right now. All right? They were a speculative play on acquisition. They clearly haven't gotten acquired. So I've given up on that. We were able to make some money trading it along the way. We lost some money along the way. All things being equal, if you made the good trades, remember on this BS move, there was money to be made. You should have at least broken even on this and not held once we got to the point when I called for this yellow alert, because speculative stocks in a yellow alert are to be sold. And I think that's the case here. I like this company a lot. I like the people at the company a lot. I mean, I really like some of the people involved with this company, but we have to see progress. And I'm just not seeing it right now. Okay, we are officially in lightning round. So the rest of the questions, sorry if you guys didn't ask your question earlier, you're going to get the short response. Let's see what we got here. About your views on Fathom and IDM with respect to real estate, do you believe there's value in buying cash flow positive REITs? I don't know. I'm not a REIT specialist. Tecogen announced their earnings yesterday, stating that it offered its technology to NVIDIA and AMD at the current price. Is it a good buying opportunity? I don't care what they offered. I gave you my opinion of this a while back. I think in a world where AI racks are going to be submerged in dielectric fluid, you're not going to need as many chillers, much less the niche of Tecogen natural gas chillers. And by the way, there's a bottleneck in the AI ecosystem which lets companies figure this out, and that's why Tecogen isn't doing so well. I'm not a fan of Tecogen. Let's see what we got here. TH said in their earnings that it is expecting ICE contract in Texas after the shutdown. Is this a good time to start a position? I'm not an expert on TH. You can see I've removed the lines here. I wouldn't be involved right now. I do know some smart people who understand the company better. If you own the stock, if you like the story, can you hold the stock? Yes. Okay. I wouldn't go against the people who like this company. They're very, very smart people. But I myself, I'm not in it right now because I don't know the company well enough. It's not my area of expertise. We are in a yellow alert, so I want to be in safer names that I know well. You saw the names I gave you, those picks of the week, things like that. Those are the names that I want to stay focused on, and you can see why. Because this week, we made money. How did we make money in a week like this? Simple. We were in the right names and we had a boatload of RWM, which went up a boatload yesterday. That's how you make money in up and down markets. And trust me, we're going to lose money in down markets too. But we, over time, averaging 45% per year versus the stock market, which only averages 7, there's a reason for that consistent performance, and that's being disciplined and professional with decades of mentored experience. Okay? You don't have that. Almost all of you don't have that, and that's not a knock on you. The reason that I'm saying this is to you is so that you don't get an inflated ego of your ability to make money in a stock market. You don't. If you don't meet the qualifications that I just told you, you don't. Trust me, because I didn't either until I had those qualifications. It's not a knock on you. There's 2 ways to be a stock investor out there, right? One is to follow other picks. One's to make your own. It's okay if you're not in that second camp because very few are. That's where I'm here to help you with 2 hours a week. All right, we got 5 minutes left. How much is Intermap baking into their revenue estimate for Q4? They can get it done. I think I said it last week. Indonesia has money that it's use it or lose it money. If they don't use it by year end, it gets lost. So there's I think a very good probability that Intermap gets all that business crammed into Q4 before Indonesia loses that money. Okay? If not, then there might be something wrong. But hey, these are the risks you take in situations like this. And Intermap is probably the highest risk reward situation over the next 2 months. You could lose a ton of money or make a ton of money on Intermap. Okay, so because of that speculative nature, I have a smaller position in Intermap than I ordinarily would because I don't want to take those high risks. I still tell people, hey, this could be a bonanza or a blow up. And the bonanza could be much higher than the blow up. So the risk reward is great, but you got to be careful because in this chart right here, as you can see, we can go from 2 to 5 or we can go from 2 to 1. Those are good odds. Doubling your money or losing half. Usually when you flip a coin, you either gain 100% or lose 100%. In this case, you can gain 100% or lose 50. All right, we're in the lightning round. I need to keep going. Here we go. Do you think TSSI isn't trying to get other customers? Yes, they're trying their heart out, Ben. They're just not succeeding so far. Q says, stop lying to people. You live 2 floors above the penthouse. That's true. Facts, Q. This building, they have 3 penthouse levels. They have the penthouse, and then they have the upper penthouse, and then they have the terrace. That's the top floor, the real penthouse. So yeah, when my elevator goes up, if you hit penthouse, you're not coming to my floor. You have to hit the T. It's kind of like the Bat Cave. Hilarious. Since we can't, I'll go an extra minute over on the lightning round because I played around with that comment right there, but that was hilarious. I couldn't help. Since we can't build your risk reward charts and forecasts, how do we apply this strategy on our own, or should we use other valuation measures? Toby, first time question, so that's cool, but it's very simple, bro. The answer to your question is in this video, in this article, and in this recording. Okay? Go check that out, and you'll have the answer to your questions. If I don't answer every single one of the part of the question that you just asked, come back next week and I will answer it. Because it will be my fault at that point. Hi, Mark. Don't you think that when your audience grows beyond the current levels, it might have a big influence on the stocks you pick? Yeah, of course. But what's your point? That's why I have the rule that says don't chase. I don't encourage. You see my disclaimers at the beginning of the show? I don't want you guys to be chasing things based on what I say, right? If something takes off, let it go. Wait for it to come back. I like something when I tell you I like something, not at a higher price. which is why I reserve the right to take advantage of market movements, because I'm not here to manipulate stocks. But it can't be helped that when you do good work that you're going to attract people. Okay, I got about I actually have 10,000 followers worldwide. Let's see, what do we got? Oh, good Lord. Looks like we got a lot of questions here. Oh, my Lord. All right, we're going to go super lightning round now. What would you like to see from air to confirm the 10 cylinders? I already explained that. How do you justify buying more Geodrill if you have a 7% position in it? If you're following the rules, you can't, but I don't always follow the rules. And by the way, the book value, you can definitely bend the rules on a stock that you have book value underlying. That's like IZEA. You're not really paying $5 for the stock, you're really paying $2. So you could adjust for that. Let's keep going. Could Geodrill aggressive depreciation and tax payment done in 25 be done to hide profit? I mean, it's not intentional. It's just the accounting principles that they have to follow. But yes, it masks a highly profitable business. Marcy said, thank you, Marcy. I see you all the time. I see you pop up. You're doing a lot. You are a great member of the team. So I am I'm going to add an extra minute for you onto the lightning round. We're not stopping at 3:55. We'll stop at 3:57 because I promised an extra minute for what I said and an extra minute for what you said now. So everybody can thank Marcy for the extra questions that I answered. For TSSI, you were concerned about the gross margins. The quarter was 24 before depreciation, blah, 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 blah. I already explained myself, on that. I said what I said. No offense. I'm just answering the question. Joining late, how far are you expecting IZEA's revenues? Damn, this keeps moving on me. To decline as the improve. I don't know. I don't know what's going to happen. Okay, Kyle? I really don't know what's going to happen minute by minute, quarter by IZEA, but I am confident with the team they have in place that they're going to build a big company. And that's the important thing. And I'm paying $2, right, with $3 of cash on a profitable company. I can't resist this stock. All right, this is a great setup. And my hero, not Warren Buffett, right? But Druckenmiller. Druckenmiller to me is the real GOAT. He says that he looks at stocks 18 months in advance. And if I look at IZEA 18 months in advance, as opposed to 1 month or 3 months or 6 months, 18 months in advance, I see a home run. So I have to swing at the pitch. The CEO of Gatekeeper mentioned months ago having bids on $70 and $100 million deals. Do I have insight? No. Could be wrong, but believe yesterday you mentioned you would discuss a company buying all the Geodrill drills. Still time for that. Chris, no, I don't. But be the first question next week, and we'll talk about that. Great pickup, by the way. I love when people are paying attention, and sorry I didn't have that in my notes to talk about this week. Can you show the charts for EVLV and PPSI? There's your EVLV. There's your PPSI. Moving on. During a bad move on a good stock, is it okay to do options then? No, bro. Don't get into options until you master. Until you are an absolute master at what I do, stay away from options, please. They will get you burnt if you don't know what you're doing. All right, I don't advise it. I make 6 figures a year on options at least, okay? But it's not by buying options, it's by selling them to the dummies who buy options. Do you have a large concern with Intermap keeping guidance but not discussing? Yeah, of course, I discussed that already. And we are now at 3:58, so the rest of y'all, I'm sorry, we don't have time to get into the rest. Show up earlier next week, ask your questions so we can get to them. I hope you respect and appreciate that I went a little bit over. It gives me less time to look into the marketplace and see what stocks I might want to buy or sell as we go into the close. But hey, man, that's how it is. Every week, Fridays at 2 o'clock. Give me that thumbs up if you love what you heard here, because that's what keeps me going. And we will be back next Friday with Money Mark on Stock Talk Live. Have a great weekend. Take care. Let's see what we got here. We got some visitor coming. That's great. That's good. That's good. Let's give that a heart. Boom. Let's see. Where's the IWM's up marginally. We're up marginally. That's cool. That's cool. Nothing to see here. Oh yeah, we want to get rid of that. Not a stock that I talked about on the show. I just don't want to be in this stock anymore. Not a stock I've ever talked about. That was a losing trade. See, you break the rules, you lose money. Money market breaks the rules all the time still, loses money. That's what you get.